Every time oil spikes, the reaction feels immediate, emotional, almost automatic. Gas prices surge overnight, markets drop sharply, headlines turn dramatic, and investors, almost like clockwork, rush into the same trades. They pile into energy stocks, gold, and anything that benefits from chaos, while dumping technology, consumer stocks, and growth assets. It feels logical. It feels safe. And historically, it's been wrong. This isn't a theory or a prediction. This is a pattern that has repeated itself across decades, across wars, across economic cycles. From the 1973 oil crisis to the 1979 Iranian Revolution, from the Gulf War to the 2008 oil price spike, and even the Russia-Ukraine war, the same investor behavior shows up every single time. And every single time, the real opportunity ends up being somewhere else. So the question isn't just what's happening now. The real question is, are you about to repeat the same mistake that investors have made for 50 years? The current crisis feels different, but is it? Right now, the fear is centered around one critical choke point, the Strait of Hormuz. This narrow passage handles roughly 20% of the world's oil supply. When disruptions hit this region, the entire global market reacts instantly. Prices spike, supply chains tighten, and uncertainty spreads faster than the oil itself. On the surface, this situation looks extreme. Tankers are delayed, supply is constrained, oil prices surge rapidly. But here's where most people get misled. Every oil crisis feels unprecedented in the moment. Every spike looks like this time is different. And yet, when you zoom out and look at the data, a completely different story emerges. The data: 5 oil crises, 5 reversals. Let's strip away opinions and focus purely on historical outcomes. In 1973, oil quadrupled during the OPEC embargo. In 1979, prices surged again during political instability in Iran. In 1990, oil doubled after Iraq invaded Kuwait. In 2008, oil skyrocketed to record highs driven by speculation. In 2022, prices surged again during geopolitical conflict in Europe. Different causes, different decades, same reaction. And the result? Oil prices reversed every single time, not slowly, not gradually, but often violently. Energy stocks that looked unstoppable at the peak eventually gave back massive portions of their gains. Meanwhile, the assets that investors had just sold in fear, especially growth and technology, became the biggest winners during the recovery phase. This is the part most people miss. The peak fear moment in an oil crisis is usually when the worst decisions are made. Why investors keep getting this wrong? The mistake is simple, but powerful. When oil spikes, investors chase what's already working. Energy stocks are rising, so they buy energy. Tech stocks are falling, so they sell tech. It feels rational in the moment, but markets don't reward reaction. They reward positioning. By the time the average investor buys into energy, those stocks are already pricing in peak conditions. And by the time they sell growth stocks, those names are often trading at deep discounts. This is what creates the reversal. Markets are forward-looking. They don't wait for things to improve, they move the moment conditions stop getting worse. Why this crisis is less dangerous than it looks. Now, to be fair, not all oil crises are identical. There are legitimate concerns today. Supply disruptions can impact inflation, transportation costs, and global trade. Diesel prices in particular affect everything from food distribution to e-commerce logistics. But there's one critical difference between today and past crises. The global economy, especially the United States, is far less dependent on oil than it used to be. In 1979, oil made up a much larger portion of economic output. Today, that dependency has dropped dramatically. Cars are more fuel efficient. Energy sources are more diversified. Remote work reduces commuting demand. Renewables are playing a growing role. This doesn't mean oil doesn't matter. It absolutely does. But it does mean that a $100+ oil environment today doesn't hit the economy nearly as hard as it did decades ago. And that changes everything. The only thing that actually matters: recession risk. Here's the key insight that ties all of this together. Oil spikes alone don't determine market outcomes. Recessions do. If an oil crisis triggers a deep recession, markets struggle. If it doesn't, markets recover quickly, often faster than expected. Historically, most geopolitical shocks, including oil crises, have led to relatively short market drawdowns. The average decline in the S&P 500 during major geopolitical events has been modest, and recovery tends to follow within weeks, not years. That's the part that contradicts the headlines. Fear lasts longer in the news than it does in the market. So where is the real opportunity? If chasing oil is the wrong move, then what's the right one? The answer lies in what gets sold off during the panic. During oil spikes, investors rotate out of growth sectors, especially technology. Companies that have nothing fundamentally wrong with them suddenly trade at lower valuations simply because sentiment turns negative. This is where opportunity starts to build. Consider major technology players like Advanced Micro Devices, Qualcomm, Dell Technologies, Micron Technology, and Broadcom. These are not speculative startups. These are established companies with real revenue, real earnings, and real market demand. Yet during periods of fear, their prices often disconnect from their fundamentals. That disconnect is where long-term investors find value. The 2022 playbook, a real example. The most recent example of this pattern played out during the Russia-Ukraine war. Oil surged, energy stocks rallied, tech stocks dropped sharply. At the worst point, growth-heavy indices had fallen significantly. Investors were convinced that energy would continue outperforming indefinitely. But within months, oil prices pulled back, and the assets that had been heavily sold, particularly tech, staged a powerful recovery. The swing wasn't small. From the bottom, growth assets delivered massive upside as fear faded and capital rotated back into undervalued sectors. The role of sideline money. There's another factor that makes this setup even more interesting. Right now, trillions of dollars are sitting in cash and short-term instruments, waiting. This capital isn't chasing oil at peak prices. It's waiting for clarity. And when that money moves back into the market, it doesn't typically flow into assets that are already expensive. It flows into discounted quality. That means strong companies trading below their intrinsic value, not sectors that have already surged. The risk you can't ignore. Now, it's important to stay grounded. This pattern isn't guaranteed. No market outcome ever is. If supply disruptions last significantly longer than expected, or if geopolitical tensions escalate further, the situation can evolve. Duration matters. A short disruption leads to a spike and reversal. A prolonged disruption increases recession risk. That's the variable to watch, not headlines, not daily price moves. Duration. The bigger picture, what this means for investors. When you step back, the pattern becomes clear. Oil crises trigger fear. Fear triggers emotional decisions. Emotional decisions create mispricing. Mispricing creates opportunity. The mistake isn't reacting, it's reacting the same way every time. Buying what's already gone up, selling what's temporarily down. That cycle has repeated for decades. And it continues because human behavior doesn't change even when the data does. The window most people miss. Every oil crisis creates a window, a brief period where fear dominates logic and prices disconnect from reality. That window doesn't stay open for long. It closes the moment uncertainty begins to fade, often before the news cycle catches up. History doesn't guarantee outcomes, but it does leave patterns. And one of the clearest patterns in financial markets is this. The best opportunities rarely look obvious in the moment. They look uncomfortable. They look risky. They look wrong. until they aren't. So the next time oil spikes and headlines scream crisis, ask yourself one simple question. Are you following the crowd? Or are you following the data?